Let me walk you through 7 critical opportunities to explore before the end of the year. We're covering important deadlines, tax and estate planning strategies, as well as investment portfolio management. Missing out on these could cost you thousands of dollars in extra taxes or IRS penalties. Let's start with opportunity number 1, required minimum distributions. If you're 73 or older, you must take your required minimum distribution by December 31st. Miss this deadline, the IRS is going to hit you with a 25% penalty on the amount that you should have withdrawn. So if you have a $30,000 RMD, that's a $7,500 penalty just for forgetting. Brutal. Now the rules for this just changed with the new Secure Act 2.0 tax bill. So if you've inherited an IRA, it's especially important to check when and how much you need to withdraw this year. Now, here's the part most people don't know. If you turn 73 this year, you actually have until April 1st to take your first RMD. But here's the trap. If you delay, you have to take 2 distributions next year. That's going to be one for 2025 and one for 2026. This can easily push you up into the next marginal tax bracket. But the good news with IRA distributions is there's a strategy called qualified charitable distributions, and they can help you satisfy your RMD, and you don't have to pay any federal tax on it. If you're charitably inclined, you can send up to $108,000 directly from your IRA to a qualified charity. The amount, it never shows up as taxable income, and it counts towards your RMD requirement. It's especially powerful if you don't itemize your deductions, because let's say you normally give $10,000 to your church every year, but you take the standard deduction that everybody gets. You'll get 0 tax benefit on your donation. Instead, do a $10,000 QCD. Now, you've satisfied your requirement and you don't owe the federal government any tax on that distribution. Your church, they get the full $10,000 instead of a lesser amount if you had donated in a less tax efficient manner. The key here is they have to receive the funds by December 31st. Don't wait until the last week. Companies, they often take a couple of days to process this type of request. Now, let's talk about another powerful year-end strategy. Opportunity number 2, Roth Conversions. Roth Conversions must be completed by December 31st. After that, it's too late. There's no extension like there are for the IRA contributions. Now the question everybody asks is, should I do a Roth conversion? And of course I say, well, it depends. In the US, our tax brackets are tiered. So if you're in the middle of a bracket, any conversion up to the top of the threshold, it doesn't raise your marginal tax rate. If you want to see a detailed case study on how powerful Roth conversions can be, go ahead and click this link on the screen here and I'll walk you through an example. But ask yourself, would you rather pay now at your current rate, or are you okay potentially paying a higher rate later after RMDs and Social Security kick in? Depending on your circumstance, filling up the lower tax brackets, it often makes sense. There's also a new strategy out there that not many people are familiar with. That is a 529 account to Roth IRA conversion. If you've overfunded a 529 account for someone in your family, you can now roll $35,000 of that into a Roth IRA for the beneficiary. Now, beneficiaries on these 529 plans, they can be changed quickly to accommodate a year-end strategy. Caveat here, the beneficiary, they need to be able to contribute to a Roth IRA directly, which means they need earned income here in 2025. The contributions, they also have to have been in there for at least 5 years. And you're going to be limited by the annual Roth IRA contribution limit. But if you satisfy all of that, this can be a game changer for families with leftover education savings. Now, beyond moving money into Roth account, there's another important strategy to consider, and that's opportunity number 3, tax loss harvesting. Tax loss harvesting, it just means selling investments that have lost value to help offset gains on other investments that you've sold. Let's say you sold some stock earlier in the year and you made $20,000. That's great, but without tax planning, you're going to pay capital gains on that. And for most people, that means $3,000. But if you have other positions in your portfolio that have decreased in value, you can go ahead and sell those and offset the gains you made earlier in the year. If your losses exceed the gains, you can use up to $3,000 of those excess losses to offset ordinary income. Any losses beyond that $3,000 can be carried forward indefinitely into future tax years. Now, when doing this, be careful. Don't generate what's called a wash sale. You can't buy back the same security within 30 days of recognizing the loss. Otherwise, it cancels out. And if you're considering selling any company stock, pay careful attention to any vesting dates if you're subject to an incentive or stock plan. Now, the trick here is that you can buy a similar security. Buying an individual stock that's similar to one you sold, it can be a little tricky, but it's easier to do with other investments like mutual funds or ETFs. You get to stay invested, but you've locked in the tax loss. Now, the flip side here of loss harvesting is gains harvesting. This is especially useful for retirees or working age folks who just had a lower income year. Here's why this matters. The standard deduction on earned income in 2025, it's $31,500 for joint filers or $15,750 for single filers. But the 0% bracket on long-term capital gains, well, that's much higher. $96,700 for joint filers or $48,350 for single filers. This means you can recognize significantly more capital gains income than earned income at a 0% federal rate. Be careful about recognizing too much though. As capital gains income, well, it pushes earned income up into higher marginal tax brackets because of how the US tax system works. Now, speaking of ways to reduce your income on paper, there's a critical change coming next year that makes charitable giving especially important right now. That's opportunity number 4. Charitable giving in the last good year. This is a big one. Most people don't know about the change coming in 2026. But right now, if you itemize your deductions, you can deduct every dollar you give to charity. A $5,000 donation gives you a $5,000 deduction. But starting January 1, there's a new floor. You can only deduct charitable contributions that exceed 0.5% of your adjusted gross income. This makes 2025 the last good year to get the full deduction on your charitable giving. If you are considering giving significant gifts over the next couple of years, consider accelerating those into 2025. Now, you could directly give to your charity or church of your choice, but there's actually another strategy here that's often favored by people. That is opening a donor advised fund. You can contribute, let's say, 3 years worth of donations here in 2025 before December 31st. You get to take the full deduction in 2025 for your total contribution. From then, you get to donate over the next couple of years to the charities of your choice. This is going to be especially helpful for people who aren't quite sure the size or direction of their donation that they want to give right now. Just remember though, you have to contribute enough that when combined with your other deductions like mortgage interest or state and local tax, that it's going to exceed that standard deduction. With the new higher standard deductions, this is where bunching multiple years of giving into a single year can come into play. Now, beyond charitable giving, there's another type of expense here that can help you increase your tax deductions. That's opportunity number 5, medical expenses and FSA funds. Another way to increase your total tax deduction is medical expenses, but only amounts over 7.5% of your adjusted gross income will help increase the level. That can be a pretty high bar for some people. Say if your AGI is $150,000, you would need more than $11,250 of medical expenses before any deduction at all counts. But if you're close to that threshold, consider accelerating expenses from 2026 here into 2025. It can be simple things like stocking up on prescriptions, getting a new pair of glasses, or even going to the dentist. I know we're pretty late in the year, but sometimes offices can squeak in a visit. Now, on the topic of medical expenses, if you have a flexible spending account through your work, these plans are use it or lose it. Check your balance. Many people lose hundreds or even thousands of dollars every December just because they forget about their FSA. If you've got money sitting there, you want to spend it. Now, your plan, it might offer a grace period into 2026, but you have to check it because not every plan does. And although medical expenses paid with FSA funds don't increase your tax deductions, it's never going to be efficient to let this money just disappear. Okay, now let's shift gears from spending money to a more pleasant topic. Opportunity number 6, the annual gift tax exclusion. This one here, it's truly use it or lose it. In 2025, You can give $19,000 to every person you want without any gift tax consequence. If you're married, you and your spouse can give $19,000, or that's $38,000 per recipient. You can't make up for missed years, and you don't get to roll over any unused exclusion. This exemption, it's incredibly powerful for families as part of their estate planning process. Let's say you have 2 married children and 2 grandkids. If you want to give the maximum to each of the 6 people, you and your spouse could give $228,000 this year, $38,000 per person. You won't pay a penny in gift tax, and you won't use up any of your lifetime exclusion. Now, I recognize that not many people have this level of assets to pass on, but for those that do, avoiding the 40% federal estate tax becomes incredibly important. A common place I see a strategy for gifting is 529 education plans. You can superfund these 529 accounts by giving up to 5 years worth of contributions at once. That's $95,000 per beneficiary from each grandparent here in 2025. Just remember to make the election on your gift tax return, and the deadline is December 31st. Now, if you're planning to pass on money after you're gone, consider implementing a giving strategy now. Giving with a warm hand rather than a cold one, it's often going to lead to more fulfilling outcomes for everybody involved. Now, finally, let's talk about how everything here works together. Opportunity number 7, tax bracket management. The biggest mistake I see people make is looking at each one of these decisions in isolation. You need to look at your entire tax picture. Implementing some or all of the strategies I mentioned, it significantly changes your total tax picture for the year. We've discussed accelerating deductions, making charitable contributions, paying medical bills, realizing investment losses or gains, and even changing the tax treatment of your retirement funds. Understanding which tax bracket jumps matter most, it's crucial to long-term planning. Some tax bracket jumps aren't as painful. Going from 22% to 24%, it's only a 2-point increase. But others are much greater, like 24% up to 32%. And on top of that, there are additional tax thresholds and phase-outs that are in our tax code, but there's just too many to mention here in this video today. Sometimes the goal isn't always to pay 0 taxes in the current year. A bigger goal would be to pay the least amount of tax in total over your lifetime. Tax bracket management is an important, albeit complicated strategy in everybody's long-term plan. If your current advisor avoids talking about tax planning, or you aren't yet working with a fiduciary, it might be time to revisit who's supporting you through all these tough decisions. At Glow Financial Planning, I help people address these tax issues head on, and we certainly don't wait until December to start working on a comprehensive strategy. These 7 opportunities, they're available to you right now. But the rules, they're always changing. There's more unique situations and opportunities out there depending on your circumstance. I want to hear from you. Let me know in the comments what you're thinking about doing at the end of 2025 to set yourself up for success in 2026. And if you found value today, consider subscribing. For more videos on planning your future, I'm Jordan Drinkhouse. I'll see you in the next video.